Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Pada sidang akhbar ini, Bank Negara Malaysia akan menyampaikan taklimat mengenai prestasi pertumbuhan ekonomi negara pada 10 tahun ketiga tahun 2019. Taklimat ini juga merangkumi perkembangan moneteri dan keuangan di Malaysia. Taklimat ini turut dihadiri oleh Ketua Perangkawan Malaysia Datuk Seri Dr. Muhammad Uzair Mahidin. DOSM adalah agensi rasmi yang mengumpul dan menerbit statistik KDNK negara. Please allow me to continue the presentation in English. The global economic environment remains challenging. Most major advanced and emerging economies are experiencing a synchronized growth moderation. This has been partly attributable to the slowdown in global trade activity amid unresolved trade tensions, which have also contributed to volatility spikes in financial markets. GDP growth across major economies moderated further in the third quarter of 2019. In advanced economies, the slower growth was due to the slowdown in investment and trade activity, while private consumption remained stable. In the regional economies, growth was affected by the weaker external demand conditions. In some economies, there were also signs of adverse spillovers from weaker trade into private sector expenditure. Nevertheless, monetary easing and other policy measures provided some support to domestic demand. Global policy uncertainty has been elevated since early 2018, particularly following the emergence of trade tensions as well as several geopolitical developments, including Brexit. This rising uncertainty has contributed to bouts of financial market volatility. In addition to the slowdown in global trade, protected policy uncertainty and financial market volatility are also weighing on the global growth outlook. Let me invite Datuk Seri Dr. Muhammad Uzair to announce Malaysia's third quarter GDP growth performance.
Malaysia. DOSM have published statistics and short-term economic indicators on a monthly and quarterly basis. This statistic has portrayed Malaysia's current economic situation for the third quarter 2019. Globally, the moderation in the world economic scenario has affected the economic performance, in which considering Malaysia as one of the open economies in the world. The gross domestic product GDP posted a growth of 4.4% against 4.9% in the preceding quarters, with a value of RM 360.1 billion at constant price. The service and manufacturing sectors remain as the main drivers to the economy for the third quarter of 2019. Services sector sustained by posting a growth of 5.9% following the post-state holiday and normalization. The growth was impelled by wholesale and retail trade, information and communication, and food and beverages accommodation. Meanwhile, manufacturing sector grew 3.6%, supported by electrical, electronic and optical product, petroleum, chemical, rubber and plastic product, and transport equipment, other manufacturing and repair. The growth in manufacturing sector was also affected by ongoing weakness in global demand for E&E product. And if we look at the industry in overall, we can see that the production of the export-oriented industry during this quarter grew by 2.7%, while the production of domestic-oriented industry expanded by 5.9%. On agriculture sector, the sector registered a moderate pace at 3.7% due to the moderation in production of oil palm and decline in the production of forestry and logging to a negative 12.3%. Nevertheless, livestock and rubber rose to 7.0% and 7.3% respectively, which has mitigated the overall performance of agriculture sector. Conversely, construction and mining and quarrying sectors contracted to 1.5% and 4.3% respectively. The decline in consumption was attributed by deceleration in non-residential building and residential building, while mining and quarrying sector affected by reduction in production of crude oil and condensate and natural gas, following maintenance works that mostly affected oil production in this quarter.
Thank you, Dr. Sri. On the demand side, private sector expenditure continued to anchor growth. Household spending was sustained by continued employment and income growth. I will elaborate more on this in the subsequent slides. Net export remained supportive of growth due to faster decline in imports relative to exports. Private consumption growth moderated but remained firm at 7% in the third quarter. While labour market conditions remained supportive, household spending continued to normalize from the strong tax holiday spending last year. Moving forward, private consumption growth will remain supported by continued wage and employment growth. In addition, measures in the recent budget will provide additional impetus to household spending. As such, effective execution of these measures is critical. As mentioned earlier, employment and income continued to expand in the third quarter, supporting household spending. Despite moderating wage growth in the manufacturing sector, services wage growth remained relatively sustained. Retrenchments in the first 9 months of 2019 were higher at 24,600 persons. Nevertheless, employment rose to 15.2 million persons in the third quarter, compared with 14.8 million in 2018, which represented an increase of 358,000 persons in the first 9 months of the year. In addition, unemployment rate remained stable at 3.3%. Private investment growth expanded marginally by 0.3% in the third quarter of 2019. The performance was weighed down by weak machinery and equipment spending amid weaker external demand and business sentiments. Going forward, investment activity is projected to remain modest amid headwinds from heightened global uncertainties and persistent weakness in the property market. On the external front, Malaysia's export growth declined by 1.9%, while import growth recorded a sharper contraction of 5.8%. Malaysia's diversified export base has helped to somewhat mitigate the impact of weaker E&E and commodities exports amid stronger growth in non-E&E exports. This is reflected in Malaysia's export performance compared to other regional economies. Moving forward, while external uncertainties remain, Malaysia's exports will be supported by demand for growing niche product segments such as the medical and aerospace industries and the IoT applications, in continued recovery in commodity production and capacity expansions in the manufacturing sector. The current account surplus of the balance of payments amounted to 11.5 billion ringgit, or 3.1% of GNI in the third quarter. The goods surplus widened to 30.8 billion ringgit as the decline in import growth outpaced export growth. The services account registered a smaller deficit of 1.6 billion ringgit. This was driven by an increase in the travel account surplus following higher tourist arrivals and per capita spending. Meanwhile, the primary account registered a larger deficit of 12.2 billion ringgit as profits earned by foreign investors in Malaysia continued to outpace that of Malaysian firms investing abroad. Looking ahead, the current account is expected to remain in surplus, driven by sustained goods surplus amid continued demand from key trading partners. Headline inflation was higher in the third quarter, mainly reflecting the lapse in the impact from GST zeroization between June and August 2018. For 2019 as a whole, the average headline inflation is expected to be low. Moving into 2020, headline inflation will remain modest, although it is projected to average higher than in 2019. This reflects factors such as the expected lifting of fuel price ceilings amid relatively subdued global oil prices and policy measures to contain food prices. Underlying inflation is expected to remain stable, supported by continued expansion in economic activity and in the absence of strong demand pressures. There has been some debate on rising food prices, particularly imported items, and the role of the exchange rate in contributing to this issue. Notwithstanding Malaysia's status as a net food importer, it remains self-sufficient for a number of basic food items. Only certain items can be said to be import-dependent, such as beef, fish, and chilies. Overall, imports form about a quarter of total food supply, as seen on the chart on the right. When we analyze the impact of the exchange rate on imported food items, we find that the impact to food prices is limited. This is tied to the fact that imports are only one component of total production costs. Others include labor, utilities, and logistics. Prices would also be affected by industry margins, market structure, as well as other policies and regulations. We also find that exchange rate impact varies by food item. To illustrate, it is estimated that the exchange rate pass-through to imported food inflation is around 26% for Indian mackerel, compared to 8% for apples. As such, any impact on household expenditure would consequently differ depending on what households consume. On average, it is estimated that a 10% depreciation would result in a 0.3 to 0.4% increase in food expenditure. Ultimately, the issue of rising food prices has to be addressed holistically. As such, an appreciation of the exchange rate would not be the main solution, and reducing imports alone may not necessarily result in lower prices. For instance, local production of certain food items could still require imported inputs. In addition, a lack of economies of scale would mean that it may not be economical to produce locally, making it cheaper to import. To this end, the relevant domestic policies currently proposed, which are aimed at structural issues, are timely and warranted. These include diversifying import sources, streamlining regulations, and modernizing production and distribution technology, amongst others. For more details, please refer to the box article in our quarterly bulletin. Domestic financial markets continue to be affected by global developments. Despite global monetary easing, investor sentiments remain subdued for the quarter amid uncertainties surrounding global trade negotiations and the global growth outlook. Reflecting these external factors, the performance of domestic financial markets was mixed. The ringgit depreciated against the US dollar, while sentiments in the domestic equity market remained weak. Government bond yields, however, declined in line with lower global interest rates and supported by non-resident inflows into the domestic bond market. In the near term, two-way capital flows and financial market volatility should be expected due to continued external uncertainties. The Malaysian bond market remained resilient and stable. Non-residents holdings of government bonds increased marginally in the second half of 2019 to 22% as government bond yields in major developed markets continued to be depressed. Long-term investors remain key holders of Malaysian government bonds, with 51% of non-resident holdings attributed to central banks, governments, pension funds, and insurance companies. The bank continues to focus on the implementation of the various financial market development initiatives that were announced in May and August this year. The dynamic hedging program continues to gain traction, with several new large accounts onboarded, with greater flexibility provided to actively manage FX exposure via appointed overseas office or onshore banks. The average daily secondary bond market trading volume has also increased, recording 5 billion ringgit year to date. Following a recovery in emerging market sentiment, Malaysia's 5-year CDS spread has also narrowed. Average daily FX transactions increased to $12.3 billion to date compared to 11.5 billion in 2018. The FX swaps and forward markets also continue to grow as investors shift their hedging activities onshore. The AOO program continues to expand to facilitate settlement of trades and investment. The launch of the pilot bank initiative involving 7 banks has further enhanced market liquidity and reduced transaction costs for larger volume of transactions by allowing inter-AOO squaring of positions for more efficient price discovery. External debt declined by 14.6 billion ringgit during the quarter. This reflects primarily a decline in intercompany loans and net repayment of bonds and notes. Overall, the favorable maturity and currency debt profile and availability of external buffers provide resilience against potential shocks. Moving on to the financial system, overall domestic financial stability continues to be preserved. In the recent quarters, the impaired loans ratio edged higher, reflecting firm-specific developments and rising defaults among some housing loan borrowers. Despite more challenging conditions, most businesses and households continue to demonstrate sound debt servicing capacity. Banks' overall asset quality remains healthy, with ample provisions being set aside. Financial institutions also continue to maintain strong capital and liquidity buffers. This is further affirmed by our stress test. Over the past decade, we have observed a build-up in surplus liquidity, particularly over periods of strong inflows. During this period, the SRR ratio was raised from 1% to 4% in 2011 to withdraw excess liquidity from the banking system. However, a substantial amount of these inflows have reversed in the last few years. As there is now less of a need to absorb the excess liquidity from the banking system, the bank recently reduced the SRR ratio from 3.5% to 3%. This will lend further support to orderly market conditions and effective liquidity management by banks. On the issue of financing, the bulletin features an article which provides further insights on bank lending trends. It examines the effects of structural and cyclical trends on bank lending. The data shows that banks continue to be willing to lend, in particular for home ownership and to SMEs. Notably, approvals and disbursement in 2019 are comparable or higher than the levels observed in past years. Banks also have strong incentives to increase lending, with close to 70% of their income generated from lending activities. Consistent with this, our review of banks' lending practices show that loan rejections are mainly associated with borrowers that are already highly leveraged and do not have the financial capacity to take on more debt. The bank nevertheless recognizes that some borrowers may face challenges in obtaining financing, including SMEs and home buyers. There are a wide-ranging avenues and funds in place to help these borrowers. Borrowers can obtain information and assistance through MyKNP, the IMSME platform, or AKPK. I would strongly encourage SMEs and households to make full use of these assistance mechanisms. I certainly hope the press could help us in spreading the word about them. The MPC will continue to ensure that monetary policy is calibrated to provide sufficient accommodativeness in order to remain supportive of economic activity while safeguarding price stability. Monetary policy going forward will be data dependent, assessing incoming information for any materialization of a shift in the balance of risk to the outlook for domestic growth and inflation. With the performance in the third quarter, the Malaysian economy registered a growth of 4.6% for the first 3 quarters of 2019. Looking ahead, we continue to expect the Malaysian economy to be sustained for the rest of 2019 and 2020. underpinned by private sector spending, recovery in the commodity production, operationalization of new facilities in the manufacturing and mining sectors, and the resumption of large transportation projects. Downside risks remain in the immediate horizon, stemming primarily from external factors. Bank Negara Malaysia will continue to remain vigilant and monitor this risk and its implication on the overall growth trajectory. This marks the end of the presentation.